The first DFA Dimensional Fund conference I ever went to, they made a point of saying the stock market investing is one of the only things where the more you study it, the less it helps you. Or not less it helps you, but there's no incremental benefit of studying it more and more and more. Like with almost anything in life, you want to be a chemist, you study chemistry. You want to be a baseball player, you study, swings and pitches and this and that.
Daniel Crosby is an author of a few behavioral finance books, and he calls this world that we live in Wall Street bizarro world, precisely for the point you just articulated, which is our natural tendency to action as humans, like our action bias, which is a default setting for us. It doesn't work when it comes to investing in markets. If you want more muscle, you got to do more in the gym. You got to do more with your diet and your regimen for rest and recovery and all that stuff.
Did you follow
Sorry.
up with your bar of soap statement?
Yep. Hey, you see,
You're
you
like,
love it. You remembered it.
no,
What
but
did you
that's
say?
where you respond to let people know your portfolio is like a bar of soap. The more you play with it, the smaller it gets.
My old friend Chris Gano, who definitely doesn't watch this, but maybe I'll let him know that I mentioned him in this episode so he'll watch. Speaking of soap, we went to middle school together, and I want to say it was in the eighth grade. I went to his house. He lived basically behind me. It was like a 5 minute walk from my home. He's like, "Hey man, you'll never guess what happened to me." I'm like, "What, Chris? I have no idea." He's like, "Well, my dad ran out of the shower earlier today, and he said, Chris, come here, come here. You got to see this. You got to see this. You got to see this." So Chris, kind of with a kind of puzzled look on his face, walks in to his father's bedroom, walks into the bathroom, and his father Miguel points to the shower floor and says, "Look." And he had dropped the bar of soap, and it fell and landed vertically. And I'm like, that must have been the squishiest bar of soap on the planet for that to happen. But very good. The science is impossible, but it happened.
I have one another story that reminded me about soap.
Yes.
We were in middle school. You would tell jokes, and oftentimes there was somebody that was like super cool, or sometimes you wouldn't get it, and you would like have to laugh because you're just like, A, this person's cool. B, I obviously don't get it, so I have to laugh. So you would tell a joke. Two hippopotamuses are sitting in a tub. One says to the other, "Can you pass the soap?" The other one says, "No soap, radio." That's the end of the joke. And the whole idea of telling this joke to somebody else was to see if they were just like, "Oh, that's so good," like as if they got it, even though there was nothing to get, just to see if they were not,
If they were pandering down, if they were
yeah,
trying to seek
basically just trying
approval.
to kiss up.
I see your middle school and I'll go to elementary school. Actually, this is middle school also and probably high school as well. Did you always do your homework, brother, or did every now and then you not do homework?
In middle school, I think I probably did my homework in middle school.
No, but give me across the gamut of middle school and high school. Were you just 10 out of 10 or maybe 9 out of 10?
Senior year in high school, I certainly let it slip a little bit. But before that, I had some senioritis. Before that, I was pretty diligent.
Okay, I'm saying, but pretty diligent allows for some room for error, right? Where, oh no, I didn't do that homework assignment.
I don't really remember any situations where I didn't do homework.
Jesus, dude, give me a little credit here. What I would do when I would forget a homework assignment, I wouldn't intentionally miss it, but when I would forget it, the first thing that I would do is turn to the person next to me and ask them if they did or did not do the homework. And I would continue that until I found someone who also did not do the homework, so I could share in the shame and pain of being one of the few to not have the homework assignment.
You didn't even try with that person who also didn't do their homework to do their homework with them quickly before class started?
Well, if you could, sometimes there's no hope.
Or homeroom? Did you have
No
homeroom?
hope. Well, sure, you'd be opportunistic, but once it was all gone, couldn't happen. So
Well,
wait,
what?
high school,
Okay.
Alen, we used to send Valentines to other schools, whether it was kind of local schools. You would basically pay money to have a Valentine sent to them, and vice versa. Folks could have Valentines sent to you. So that was happening. I guess it was right around Valentine's Day, and I received a Valentine, believe it or not, and it was a flower. And in this class, I had this flower and I was playing with it a lot. And I had also not done my homework that day. So the teacher, noticing how fidgety I'm being with the flower, and also having already gone through identifying me as a non-homework doer for that day, said, Marcus, you know what? Now that I'm seeing you with this flower that you apparently love and care for so much because you don't stop freaking messing with it, I will let you get 100% on this homework if you come up to the front of the class right now and eat the flower.
What?
Yeah, and I ate the flower.
Again, we hired you?
What do you mean? I'll do anything to get the result I want.
I know, and you got a free pass. You took a shortcut.
What do you mean? I owned up to it. I owned up.
What did that teach anybody? That would teach anybody that you would do anything for an A.
You know what it taught me? Flowers are not very tasty.
Welcome, viewer, episode 56, April 23rd, 2024, or they say in Europe, 23/4/24, right? They say it reverse, the month and day.
Yeah, I'll take it.
Speaking of Europe. So we're going to start off here with a uniform lifetime table. Why is this important? What is the reason that I have this chart up here, which has got all these numbers on it and age and distribution period? So a few years ago, there was a law that had to do with IRAs. And when you inherited an IRA, going back in time up to a few years ago, basically, if you inherited an IRA from anybody, you could stretch it out over your lifetime, which meant you would look up your age. In this case, this is for someone who's over 72. You would divide the balance by that distribution period, and that would be the minimum amount you'd have to take out of your IRA, also called your RMD, required minimum distribution. Up to a few years ago, that was the rule. So if you had young kids, or if you had especially a non-spouse, you pass it to them, and they can allow the money to be deferred for decades and decades over their life. However, recently they changed that rule, and they now said that all, for the most part, IRAs that go to a non-spouse have to be distributed over a 5-year period. I'm sorry, over a 10-year period. I know you looked at me funny. It was 10-year period. I was testing you. Over a 10-year period. But they said there was no rationale as to how you took it out over that 10 years, whether you did it all at once, a little bit every year, or all, in the final 10th year. However, for some people, this is a huge issue because of taxable income, things that could affect you with your capital gains or your Medicare, things like that. We now found out that come 2025, there is likely to be a ruling on this where the government will say either, yes, you have to do a part of it every single year, or no, you can wait and decide how you want to do it over a 10-year period, doesn't matter. So it's important for our clients. It's important for anyone making a decision, whether you're in a certain state, whether you have higher income going forward, lower income going forward, about to retire. It's just crucial that people pay attention to this if you have an IRA going to a non-spouse. Anything you want to add on this?
What does the IRS say about requiring year to year? They don't care at all. And they keep telling folks that if you didn't take one, it's okay for now.
Yeah, for the last few years, they've said if you haven't taken your RMD if you're supposed to, while we figure this whole thing out, you're okay. There's no penalty. But if next year they come out and say you have to do it each year, that's going to put a major change in people's plans.
Yeah, it is. There's no way they're going to make you take past ones. That would be ridiculous, but I'm sure moving forward it would change. What, Brett, if they were already, if the decedent, i.e. the dead person, was already taking distribution before they died, meaning they were past their RBD or required beginning date?
I don't recall that rule.
What?
I don't remember. There's lots of rules.
There are so many rules. I know. You know what we're going to do? Our first guest on this podcast, and by podcast, I mean this little show that we're doing, is going to be Ed Slott from the Slott Report. And you're going to book him for us.
Huge.
I can't believe you're going to book Ed Slott for us. It's going to be incredible.
I think, though, let's talk about what we do as planners, though. I think it's important on this topic. We have a tax software that we use that can help analyze someone's situation. We can run that out years and years into the future. We also know that tax rates are likely or possibly to go up in a couple of years when they sunset. And so for our clients who are in the situation where they have an IRA that they inherited, not from a spouse, and they have to take it out over 10 years, that's where we can come in very valuable and help them figure out how they should do it. A little bit each year, more some years, Maybe there's a year where they don't make much income or they have capital losses. I mean, that's the value, I think, in having a financial planner and a topic that's really, really confusing.
Yeah, I agree. Tax planning, it's an area of wealth management that's generally underutilized by advisors, and that's why we make it a point to lean into the tax planning part of things. Okay. Now, before we lose any more listeners to the boring topic of RMDs, what do you have for us relative to small caps?
So we have not done the show in a few weeks. I don't know what button you pushed or lever you played with, but something went haywire. And all the great momentum we had in the first quarter has stopped and we've reversed itself in the last few weeks. Why? Higher inflation readings, higher job readings, Fed likely not lower rates, keep rates higher for longer, which they said was a thing, although no one believed it was a thing. What does that do? That has a much bigger impact on small cap stocks. Why is that? Because small cap stocks, for the most part, use interest rates on their variable loans is used much more than big companies. So the stat here in the chart we're looking at, Bank of America calculates that over 40% of the Russell 2000, which are small companies, ex financials, have debt that's floating versus 6% for the S&P 500, which is your large cap. Small companies have higher debt as it is. And most of those big companies locked in a lot of their debt in the last few years. So they were able to take advantage of those low rates. And now they don't have any debt coming due with these higher
Okay.
interest.
That makes sense. I get it. Smaller company, bigger risk, you get floaters. But let me make sure I understand this chart. That whole circle is all of the Russell 2000 X financials. So it still means that 54% of the debt on their books is long-term fixed.
Yeah, but fixed being better than variable. So the point was that it's much more variable, which is why the interest rate changes have had a bigger impact.
Yeah, okay. So that long-term fix of 54% is just 94% for large companies.
No, fixed is, yes, 94% fixed for large companies, correct.
Okay. All right.
So, and what have we seen over the last few weeks? Some statistics. The biggest 50 stocks in the S&P 500 over the last few weeks are down 4.5%. The smallest 50% are down 8.6%. And the Russell 2000, the smallest companies, gained less in the first quarter, only up a few percent, 5%, versus the S&P big companies that were up 10%. So they had less rising when the market was going up, more falling on the market going down. A lot of this has to do with interest rates that are not likely to come down anytime soon.
Yeah, but what's awesome is that the S&P, wait, where's the S&P? Hold on a second. S&P is up 7% and Microsoft and Apple are down. No, I'm kidding. Just Apple's down 13%. So it's fun to watch the biggest company fall while the market's still going up. Love that. I gotta love that.
Well, I mean, to me, this whole interest rate thing is way overblown because the market and the economy is doing
Oh,
just fine. I know people want lower rates, but we
I
don't
want
need.
to I don't want to agree with you, but I'm gonna absolutely agree with you that the interest rate thing is overblown because this was a way bigger topic on the way to zero and on the way from zero. Now we're here and the markets are gonna care less, i.e. companies are gonna care less. That's it. And
Well,
that's why I think this, all the things that you said before about the drawdown of higher for longer, inflation being a little stickier, from my perspective, everyone already knew that in January, in December even. So I don't
well,
think it's any of that stuff. I think for the last 40 years, the market has fallen by around 15% once every 12 months, and that this is healthy and normal.
so why does the market want lower interest rates so badly?
The market wants it because it sounds good and feels good. It also wants it because the market in and of itself is probably not what we're even talking about. We're talking about consumers who want to be able to buy a house. And then we're also thinking about the commercial real estate market that is absolutely extending and pretending a lot of their debt that's going to eventually lead to a big crisis. But I think those are microcosm as opposed to the market itself. I think the market initially ignored what was happening in the probability of rate cuts. As those went to the floor, the market continued rising. I think that still happens. I don't even think we get to a 10% correction, but famous last words, we shall see.
Yeah, I mean, let's not talk about your predictions, okay? So,
Whoa, look.
whole greens, okay?
You know what? What's the next chart, Brett? Even though you know what, I actually like this chart. I did. So I think the takeaway for me is small caps, 54% long-term fixed, large caps, 96% long-term fixed. Okay,
94.
that
Yeah,
makes sense.
94.
94,
But
yes.
it's the same thing with consumers, right? You got to figure most consumers have locked in fixed interest rates, but there are some on the margin that either didn't or buying a first-time house or have to move, where unfortunately they're stuck now with higher interest rates.
I'm not buying a house because of I have a 2.7% mortgage. Like, what do do I leave that? I don't
Well,
think
if you
so,
pop
man.
out a few more kids, you'll have to.
No, I'm done. That the bank is closed. Thank you though. But it's our population needs it. So for everyone out there, please have children. It's good for everybody. Okay, on to 1990.
Somehow that gets brought into every episode.
Hey, it's important. We got to do our part. We have to do our part. Immigration is important, but so is this. Okay, so Brett, I was talking to somebody the other day, and they were asking about what we do, and I kind of gave them the high and tight on them. And they asked me about investing and all these like investment questions, and I told that person that sometimes I don't even think that what we're helping clients do is exactly investing, right? Sometimes when you think about investing from my perspective, I think it's a little bit more intellectually honest to say investing is when you take a risk, like starting a business that can turn into a Facebook, for example. Or you start a local bakery because you came from Cuba and now you brought all of that culture and you turn into a bakery and you start a small business that turns into something that hires people and creates economic value. A lot of times, from my perspective, with what we do in investing, it's more an allocation decision than anything else. And these next two charts, I think, exemplify that idea. Where if you have to just simply make a choice between allocating to cash or allocating to markets, it becomes a very, very simple thing. When you get kind of bogged down with the idea of investing and okay, what's my highest expected rate of return and all those things that I think can be a little bit more noise and signal, I think it defeats the big purpose, which is the reason you're investing is so that this doesn't happen to your money. And what we're looking at here is the purple line is the US Consumer Price Index and the absolute cratering of your purchasing power from 1990 to the end of April and what the S&P 500 has done over that time. And then the very next chart is showing us what $100,000 turns into over that same period of time. This is what makes it a much, much simpler conversation from my perspective. It's less about small cap, large cap, this, international, US, and it's to say holding cash for long periods of time, it's not a good idea. And from an allocation perspective, this is why you should be the owner of the biggest and most profitable companies on the world.
Yes, but this is why we ask a very important question on a risk questionnaire. Do you want safety and protection of principal, or do you want inflation protection? Do you want growth? Do you not? Right? So there's a lot of clients who would look at this and say, I love the idea, but the stock market is not for me. It scares the heck out of me. Let me keep my money all in CDs and bonds and treasuries and money market because I can't stomach the volatility. And I'm willing to trade things for others if I can't afford what I used to be able to afford. Right. So I agree with you. In theory, we should all like this chart and want to be invested this way. But in reality, there are some people that can't stomach it no matter what you tell them.
And I get that. I do feel some amount of professional responsibility to coach folks into taking some level of measured risk so that they do have the ability to increase the magnitude of their impact because their dollars will be greater, so their impact can be greater. If you threw the ag on here, right? Because again, you're not talking about cash necessarily, although CDs, that's kind of like cash. If you're in CDs, you're getting absolutely trounced. Your $100,000 is no longer $100,000. If you're in bonds, the ag, where do you think the ag falls on this chart? Your 100,000 turned into $1 million, something like that?
Yeah, something closer to the cash number. But we've had clients that tell us, I want a return of my money, not on my money.
But
Um,
this is not the return of your money because now it's worth $40,000.
well, no, if you're talking about you're invested in a bond, you're not going to lose money in a bond.
Yeah, hey, you can tread water for decades. Have fun.
I think there's not a lot of people that can fit in a situation where you have enough money where you can literally just make 4 or 5% and be happy with that, no matter what inflation is. There's a small subset of people that probably fits in, but for most, you need the growth because you need to make money for the rest of your life in order to be able to spend what you want to spend.
Yeah, I agree. There's always going to be nuance in the decision. I think this is a helpful chart to show you why it's really, really, really. I guess I wouldn't even call it a bad idea to be somewhat supportive of your comment. This is just going to show you what's going to happen if
This
you
is
don't put some level of risk on your balance sheet.
No, the
Is
charts
this
are
what you
fine
want for
for
yourself?
the charts are fine for the masses. They don't apply for everyone, but for most people, they're pretty charts, and you should take advantage of what's here.
Ah. Anyways, those are my charts to drive home the point that cash is king unless you're holding it for a very long time. Then it's the
Huh?
opposite. Another quick stop on the chart. What else you got to say about my
No,
cash
no,
versus stocks?
no, no. Go ahead, continue.
Oh, yeah. What can I say? I like heavier equity allocations.
Can't fight you on that premise. I agree with you.
Okay, so have you heard about all-time highs in the market? Because there's been over 20 this year.
Last time we talked, we hit 22. We were arguing whether it was 22 or 23. We never got to 23, and now we're far away from 23. So I feel
Oh,
like you
that's so
kind of
sad for
jinxed
us.
us in stopping at 22.
Yeah, but Brett, it's only 6% of the time that the S&P closes at an all-time high, as you can see from this chart here. And so look, the left side of this chart is awesome. Take it in, but I brought this really because of the right side of the chart. If you are sitting on a ton of cash and you have heard Brett talking about 22 all-time highs in the market, you might be thinking, what a terrible time to put my money to work, because over the next 3, 6, 12, 24, 36 months, I'm probably going to have terrible returns. And the reality is that's not a good way to think about it. And the right side of this chart helps you appreciate that the average cumulative return of the S&P after investing at all-time high is in line to ahead of what you would get investing at any point in time throughout a 12-month period. Thoughts?
My thought is that it's the same thing we saw in 2022 and 2023, where the market was down 20% in 2022 and up 20% in 2023. And everyone said, oh my gosh, all-time high. But average those 2 years out and you get nothing, right? So it's not as if the market screamed higher by 100% in a matter of a month. It basically did nothing for 2 years. So to have an all-time high in 2024, to me, that's the lowest amount that you would expect, given that you made nothing for 2 years. So as we said, markets go up over time. There have been exceptions. You invest at the peak. I think most people look at the peak of, in 07, and they said, I don't want to be that guy, that woman who invested in 07 and has to wait 5 years to get my money back. But that's a one in history, other than maybe the Great Depression, where that happened.
Yeah, absolutely the worst of luck possible to be that person. I was surprised by this chart in that I thought the shorter period of time would have higher returns than the longer period of time, simply just say momentum. So I was a little bit surprised that, again, it's only an 8% difference, but I was still surprised that the largest margin was at the 3-year mark as opposed to the 3, 6, or 12-month mark.
Well, but it's cumulatively. So cumulative, you'd expect that. Maybe on average, if you annualize that, you'd have a different number. But cumulatively, that's what you expect, no?
Yeah, I just thought it would show up in the shorter time more. That's all.
Okay.
Yeah, it's basically saying you're getting the same thing. I just thought you might get more because you're getting the benefit of the momentum that led to the run up.
Got it.
Not the case. That's why I'm not a statistician, BH. Okay, so back to predictions and not Walgreens. You said no recession this year. I also said no recession this year, which was against my take in 2023, where I was wrong and I said recession. Okay. So I think it's really hard to have a recession when the labor market is this good. So I'm going to read a little bit of just notes that I took here, just because this is just showing us the dynamics, and man, this is nice. So look, so we've clearly normalized from the post-pandemic boom. Last year, so the U.S. economy added an impressive 250,000 jobs per month in 23 and has sustained that pace in 24. And this has occurred as the unemployment rate has remained at or below 4% since December of 22. That's the longest streak since the late 60s.
Thank you, Joe Biden. No,
So, oh, we just lost half the viewers. Well done. That's not
that was
how
a
it
joke.
works.
Joe Biden
How
had
it
no effect
works.
on jobs.
No, you have to thank Obama for this because it's remember, it's long tail. So Obama, and actually, you know what? Now that I think about it, it was actually Bush who did some things that led to this now. Okay, there you go. Now everybody's happy. Um, okay, so check this out because this also kind of got me a little bit confused thinking about how immigration has been obviously a key issue, and immigration is also a massive component of how we're going to kind of innovate and grow our way out of this debt crisis we apparently are in. So in fiscal year 2023, Immigration Services approved over 2 million applicants for employment authorization. That's a 70% increase from a record 1.2 million in 2022. I wouldn't have guessed that. With this surge in migrant workers, employers were able to fill open jobs without applying upwards pressure to wages, helping to explain why strong job creation hasn't sparked higher inflation. That's also helpful. That also explains why the unemployment rate doesn't consistently go down and down and down because we're adding new workers that are looking for jobs. So where I would have told you without having read this or seen this before that immigration is down so much that it has to be impacting our employment rate, this leads me to believe, given the 70% increase from 2022 to 2023, it's actually not as bad as advertised, but perhaps I'm being fooled by employment authorization approvals versus other types of immigration. So either way, as you can look here, 3.8% unemployment is a great thing. And what you love to see here also on the bottom right of this chart, the labor force participation rate, while your total labor force participation rate hasn't gone up, and that's probably due to aging population of folks retiring and then retiring early, you do see the working age population, so the most important and productive part of our population, has broke the previous high that was pre-pandemic. So they're sitting just north of 77%, and that's awesome.
Yeah, I just have one thing to add, which is I hope this continues because there's obviously talk that if somebody else is in the White House next year, that we'll lose a lot of the immigrants. And then that could obviously torpedo this premise that you have and this, all this momentum we've had in the last few years. We'll see if that happens. But for now, it's definitely a good thing. And I agree with you. There's zero chance of a recession if this continues as it is.
Yeah, so there you go. Markets might drop 10-50%. That's the water cycle. That is normal. I don't see a reason why the market can't keep chugging along with a labor force participation rate and just the labor market like this, given that 70% of our GDP and ultimately your ability to buy stuff is going to be based on folks having jobs. If you have
Have a
jobs,
job,
people will
will
spend.
spend. Yep. That's all it is. Simple
Yeah,
economics.
that's it.